Okay, so corporation tax, first of all. The Chancellor reminded us in his speech that the main rate of corporation tax has come down from 28% at the start of this government to 23% currently, and in about a week's time down to 21%, and then a year after that down to 20%. We saw in my presentation last year when we were here that this rate is extremely competitive in international terms, joint lowest amongst the G20 countries, which of course is what the Chancellor's intention was. In fact, one of the very few commitments on taxation which the Conservatives made ahead of the 2010 general election was over the competitiveness of the corporation tax rate. But of course, the reducing rate of corporation tax has implications for us when we're looking at how we structure our businesses. And this has been a key issue for many clients over the last few years. Again, when we were here last year, I explained that the Chancellor had announced in the Autumn Statement 2012 that two aspects of partnership taxation were going to be reviewed. We've been following this development very closely. Now, you've all been sitting down for quite a long time, so it's time for a little bit of audience participation again. We've had the high-tech version with the Wi-Fi. This is the low-tech version. What I'd like you to do is, if you're here this morning representing a farming or rural business, or if you're a professional advisor who works with farming or rural businesses, please be upstanding. And if you, don't be shy, sir, you can be over there, not with all these people here. If you're here this morning, either as a member of a professional practice or you work with clients who are professional practices, please be upstanding also. Okay, excellent, thank you. Please sit down. So, as I suspected, probably roughly half the people here this morning are either connected with the farming industry or professional practice sectors, the two sectors where partnership structures are most widespread. So this next section, I make no apologies for going into a little bit of detail because you or your clients are going to need to think about this, I would suggest. So the key events, as I say, the review of aspects of partnership taxation was announced in December 12. Then shortly after our budget breakfast last year, the consultation document was published. Closing date for representations was in August. And then in the autumn statement in December, we had draft legislation and the technical guidance. Following further guidance with respect to LLPs last month, the new legislation will become effective in a week's time at the start of April, though of course it will still be subject to Finance Act getting royal assent in July. So what are the key issues? Who's going to be affected? Well, it falls broadly under two headings. Firstly, partnerships with mixed members. Now, traditional business structures tend to have either been a partnership, whether it's a traditional general partnership or an LLP or a limited partnership on the one hand, or a limited company on the other. In recent years, the fact that the corporation tax rates have been coming down, as we've seen, while income tax rates and national insurance payable by the self-employed have been going up, have increased the popularity of the following. First of all, corporate partnership. This, as the name suggests, is either a partnership or an LLP, all the members of which are limited companies. The second structure is the mixed partnership, where here we have, again, it could be an LLP or it could be a partnership with members that are companies and also members that are individuals. Sometimes each of the individual members, partners down here, introduces their own company, or it could be a number of individuals with one company that acts as a money box. And a mixed partnership in many ways combines the flexibility with regard to succession planning and so on of the traditional partnership structure, with the benefit of being able to shelter retained profits at the lower corporate tax rates. In my own view, this is a perfectly legitimate structure which is used for genuine business reasons. Indeed, the government's consultation document effectively acknowledged that such a structure could give the best of all worlds, was the expression used. But rather than seeing this as a practical solution to a business problem, unfortunately the government consider that such structures create unfairness and market distortion. So their remedy will be that in this sort of mixed partnership here, effectively the revenue will be able to override the profit sharing arrangement, particularly if they feel, for example, that profits that should be attributed to these individuals are being allocated in a way that's not just unreasonable to the companies. They will be able to effectively do a reallocation of the profits. As I say, the legislation is specifically about mixed partnerships. So what about the corporate partnership that we have there? Well, in these cases, if the revenue think there are individuals behind these companies who are going to benefit from the profits that are going into those companies, then even though those individuals are not, as a matter of fact, partners, the revenue can effectively deem them to be partners, and hence the corporate partnership becomes a mixed partnership, and so it goes as before with the reallocation of profits. So any clients, or if your business involves a mixed partnership or a corporate partnership, may I suggest you need to review your structure urgently. The good news is that there will often be other options to restructure and achieve the same sort of result, because all of the new anti-avoidance legislation will apply to partnerships, and there's no reason why you can't do what, for example, some of our farming clients have done, which is to operate with a limited company and a partnership alongside each other. But it does need to be reviewed, and reviewed urgently if that affects you. The second area which the government was concerned about with regard to partnership taxation was over salaried members of limited liability partnerships. Now, to be fair to the government, there has been widespread use of limited liability partnerships to turn people who are, to all intents and purposes, employees into self-employed, and in that way to avoid employers' national insurance and also to avoid car benefit scale charges. However, in my opinion, and more importantly, in the opinion of the Law Society, this problem has arisen because the revenue had a fundamental misunderstanding of what the legislation actually said. The revenue thought the legislation said that if you're a member of an LLP, then you are definitely self-employed. However, what the legislation actually said is that if you're a member of an LLP, you're taxed as though you were a member of a partnership. And as we've known for many, many years, members of partnerships can effectively be deemed to be employees on the basis of the facts concerning their engagement. So really there was no need for all of this. They just needed to use the legislation they already had in the appropriate way. In any event, we are where we are, and notwithstanding the protestations of the House of Lords a few weeks ago that this needed further thought, the draft legislation is now with us along with further guidance. And basically, if you are a member of an LLP, or you are a firm that has effectively fixed share members in the LLP, then if the following three tests are satisfied, then you will be treated as an employee with all the obvious PAYE and national insurance implications. And those tests are, firstly, if basically 80% plus of what you earn is a fixed amount, if you like, a disguised salary, then condition A is satisfied. If you don't have significant influence in the running of the business, then condition B is satisfied. And general thinking is that the bigger the number of members in the LLP, the more difficult it will be to demonstrate that one person has significant influence, unless they are in some sort of management committee role. And condition C is around the level of capital. If the level of capital is less than 25% of the disguised salary, then condition C is satisfied. And as I say, if all three of those conditions are satisfied, then no matter what else is going on there, you will be treated as an employee. So any business operating through an LLP needs to review its arrangements urgently to see if it has an exposure when this comes in a week's time. However, it might be that the revenue have actually shot themselves in the foot because they've replaced a series of very subtle and nuanced status tests with these very categorical 3 tests. It might actually be easier now to ensure that a fixed share member is self-employed by breaking one of those conditions. And general thinking is condition C, which is over the capital test, is going to be the easiest to break. So it might even yet turn out to be an own goal on the part of the revenue. We shall see. Moving away from partnerships now, I'm sure we were all, being Cheshire folk, delighted and very proud to hear that Bentley at Crewe is going to become Volkswagen Group's World Centre of Excellence in V12 engines. And with that in mind, the Chancellor announced that this was a budget for the makers, with a packet of measures for manufacturers, including cutting of energy costs to enable them to compete with international rivals. I want to just focus on 2 areas where there have been changes, where we're already working closely with our manufacturing clients. First of all, in the area of R&D tax credits. Over the past number of years, we've been successful in making R&D tax credit claims for a wide range of clients, with products as diverse as dairy products, pharmaceuticals, engineering, and IT. R&D tax credits are effectively state aid for businesses that are involved in overcoming technical problems to develop new and innovative products and processes. The relief is usually given by reducing the business's corporation tax bill, which enables that cash to be retained within the business. But this is of very little use for businesses that are loss-making, which high-tech startups often are in the early years. So there is an alternative form of R&D tax credit relief, which is a repayable credit. And the good news from the budget is that from 1st of April 2014, the rate at which that's repayable is increased from 11% to 14.5%. The government's intention is to support small, innovative companies with high growth potential. Approximately a quarter of the R&D claims that we make on behalf of clients are for repayable tax credits. So we welcome this change, but we still believe that the R&D opportunity is being significantly underutilised. So if you come across businesses, or if your own business has that kind of innovative technology product, please do talk to us about whether we think there's a possible claim there. Generally, we would do the claims on a contingent fee basis, so if ultimately there isn't a successful claim, it doesn't cost the business anything for us to have a look at it. And finally, another surprise in the budget was in the area of expenditure on plant and machinery. In a surprise announcement last year, the Chancellor announced a temporary extension or temporary increase in the annual investment allowances for businesses buying plant and machinery to 250,000, which was to run through to the end of this year. He surprised us again in this year's budget by increasing that from 1st of April to £500,000 and extending that to run through to the end of 2015. The Chancellor estimates that this means that 99.8% of UK businesses will now get full tax relief on their capital expenditure on plant and machinery in the year of purchase. And don't forget the opportunity around plant and machineries, which is integral to buildings, which is another area where we've been working with clients to enable them to maximise their tax relief over the past few years. So finally, just a summing up of the planning points that come out of this presentation. First of all, with corporation tax coming down, the rate of corporation tax coming down by 2% next month, do consider the possibility of deferring profit into the financial year 14 rather than financial year 13 if your business is paying corporation tax at the large rate or the marginal rate. Secondly, if your business involves partnerships, it might well be time to have a look at the structure and see whether that's still optimal under the new regime. LLPs need to go away and have a look at their partnership agreement and the basis on which their fixed share members are remunerated to make sure that they're not now deemed to be employees. Don't forget about the R&D opportunity. It really is money back from the government, a very easy way to add some real benefit to your business or your client's business. And finally, in view of the increase in the annual investment allowance, it's time to be looking again at your capital expenditure plans and your CapEx budgets and deciding in which year you should be building that new plant or that new factory or buying that large machine to optimise the tax relief. That concludes my presentation, ladies and gentlemen. Thank you for your attention, and I'll now pass you back to Chris, who will round up the proceedings.